All right, guys, the question is, how do you exit a position? Now, this depends. If you're an investor, you do it one specific way. And if you're a trader, you do it an entirely different, but still specific way. Let's jump into the two different ways and we'll get to it. So the question is, how do you exit a position? So I'm going to talk about both investing and trading. And with each one, I'm going to give you 2 points. Okay, and then what I'm going to do is wrap it up at the end in a way where there's 2 things you have to do. Whether you are 10 days into investing or trading or 30 years in, if you don't have the performance you want, I absolutely know how you can increase the performance by doing 2 things specifically. So first, let's talk about investing. How do you exit a trade? How do you exit a position if you're an investor? So this is very different. As an investor, you want to stay in the longest possible time. And all things being equal, the market wants to go up. So we have to think about this and we have to make the assumption that the investment you own is already going up, which is a dangerous assumption because a lot of people buy investments that aren't even going up. So before I even get into the 2 ways of how to get out, how to exit is, first, you have to be buying something that's already working, right? This is even like point 0. If you're not buying something that's already going up and to the right, we don't even need to have this conversation. So just if you're going to invest in something, whether it's investing or trading, that symbol, that black squiggly line, which it's usually black on most price charts, okay, and going up and to the right, it has to be going up and to the right. Okay, now here's the question. How do you exit with an investment? So these are the 2 ways that I trade. Number 1 is you don't get to determine when to exit. The price does. So this is a theme you're going to hear throughout this video. You want price to tell you when to leave. With investing, you want to give the volatility, the natural volatility of that symbol more space. You want to give it more breathing room. And the more breathing room you give it, the better your performance is going to go. Now, I'm going to tell you the number of how much you want, right? Because there's 2 ways to exit an investment. One is using moving averages, and the other is a trailing stop loss. Okay, but let's just talk about trailing stop loss right now. Most people are not going to like what I'm about to say. The best trailing stop loss is actually 34%. Now, I'm talking, this is for larger symbols. This is for investing. So you're not going to be investing in a symbol that went up 30 times in a year. An investing approach is going to be more like, okay, let me start with the index. Let me get something that maybe is beating the index slightly better. But the first thing I want you to hear is you have a trailing stop loss, okay? And as scary as it sounds to a lot of people, because we're not putting the whole picture together, we're just talking about how do you exit a position. So number 1 is a 34% trailing stop. Okay, trailing stop loss can be 25%. Now, I will tell you, if you are an investor and you have a 7% trailing stop loss, you're confused. Investors don't have 7% trailing stop losses. Maybe a trader does because they're looking for that quick move, okay? But if you fancy yourself an investor, then right away you're going to want a bigger or wider trailing stop loss. So that's a big way of understanding, like, who are you? Because most people are confused. Like, they go in thinking they're an investor, but then all of a sudden they become a trader, right? That's typically what happens. It typically doesn't happen the other way. When someone goes in as a trader, they have very clear points, or at least they ought to have very clear points when to get in and out. I'll get to trading. So the first thing with investing is a trailing stop loss. And as scary as it sounds, a 34%. Now, here's the thing. If that scares you, that's fine. Put a 22% trailing stop loss in, right? Here's what's interesting about 22%. And there's a lot that you have to understand about the symbol, but let's just say you own the S&P 500 with dividends reinvested. The market defends a 20% down investment. It's very rare that the market closes down 20%. Of course it happens, but it's not something that happens every week or every month or every quarter. It may happen every 2 years, which then goes to, well, I don't want to get kicked out every 2 years, which goes back to what is your system. But I want you to hear trailing stop loss is the first thing. The second thing I'd suggest to you, if you are an investor, is moving averages, specifically a crossing of two moving averages. Now, I've talked about it on a separate Ask RC video about moving averages, why they're so important, and what's the best ratio between them. And that's a key, the ratio. So you can just put in Ask RC on why are moving averages so important. But the second way for investors is when a moving average crosses, like when the faster one crosses below the slower one, that's a signal. And that signal is telling you something has changed with the symbol. So what I want to do with these videos is give you the big picture to make sure you're getting the big picture right, because a lot of people aren't even. Okay, so what I say with investing is there's two things, either a trailing stop loss, okay, or a crossing of two moving averages for an investor. Now, here's the thing if you're a trader, and it's a very different thing because it's a shorter time period, right? You're looking for a fast, bigger hit over a shorter time period. So two ways to get out of a position if you're a trader. Number one, if you hit your target, which presupposes that you have a target. You can either use a target by using Fibonacci extension lines, okay? Or if you buy a symbol that has a past but higher price above it still, then you use that higher price as kind of like a magnet that that symbol wants to get to. And when it hits that, then you've hit your target. So the thing I want you to take from this is if you're an investor, do you know your target price? Do you know when you're going to get out? And you could get out actually when you're wrong. So you have to know when you're wrong. Absolutely. But the same thing with investing. Is it trending higher? Is it moving higher? Are you getting a symbol that's moving higher? Because if you're not, you're already behind. You're already on your heels and you've put yourself in a position of weakness. Okay, so first is you have to know a target. You have to set a target, and the target has to do with the price. I keep coming back to price. Price is a theme that goes throughout all of my videos, definitely through this video. Price tells you. So with trading, you hit a target. Now, a common target to hit with trading is once you've hit 100%, you take half off the table. You just immediately take half off the table. That's an immediate, your brain's not going to want to. It's going to want to quadruple down. It's going to want to hold it forever. Brains change when our position changes, our point of view changes, our emotions absolutely change when we put money in the market. So when you're up 100% in a trade, you get out of half of your position. I'll also say this, if you've never been up 100% on a position, okay, and now you are, get out of everything. Get out of everything. If you've never had a 50% gain on a trade ever, I don't mean you've had 50 and then you've lost it. I mean you had 50 and you took it. If you've never had a 50% gain, take it. So this gets back to really understanding yourself. If you're a trader, knowing what your best number is ever, and actually knowing what your average number is, right? So for every 10 trades, what's your average gain or loss? And if your average gain is a loss, then that absolutely means you need to be taking your losses quicker. So with trading, number one is set a target. Okay, the second, and I talked about it a little bit, but I want to bring it here. The second time you get out of a position is when the price breaks down. Literally, if the price breaks down after you buy, you have to know those trigger areas where if the price breaks below a certain point, then it's your time to get out. It's similar to a target, but it's kind of like if the price breaks below this, that price is telling you that you ought to get out. You want to get out. So in some ways, that's still, it's like a downside kind of circuit breaker on the price. Okay, now here's the thing. There's lots of videos on YouTube. There's lots of information on YouTube. What I want most is for you to see, am I even doing those baseline things? Like, are you basing your getting out, your exiting on price, or are you basing on what you read on some news channel? It has to be based on price. That's number one, okay? So I'm wrapping this up. Number two, you're only allowed to buy symbols, whether you're a trader or investing, that are already going higher. Now, going higher looks like that. So you can get it as it pivots down, right? People call it swing trading and moving higher, but the trend is higher. The trend is higher. It's not sideways and it's not down. It's trending higher. This alone is going to cut people's losers significantly and help them get their winners. Again, no one's taught this. So has to be based on price. Before you buy, the thing you buy has to be trending higher. And then I'll finish with this. What's your procedure? What's your checklist? Show it to me, right? This is what I talk to my Trading Simplified students or my investing students. Like, if it's not written down on one sheet of paper, then you don't have a procedure. It doesn't count. And I say to them, you have to, and you want to have your procedure look beautiful. People who don't have a procedure or a checklist, does not matter how good their performance is, how long they've been investing. If they don't have one, they are hurting themselves. They are leaving money on the table. They are taking bigger losses than they need to. So the big takeaway is everything has to be based on price. You want it based on price. That's number one. Number two, trending higher. Whether you're an investor or a trader, have that thing be trending higher. It's going to make you a much better investor. Whether you're a swing trader, day trader, whatever trader, it's amazing at how many people who are trading by crappy symbols. And then number three, if you don't have a checklist, you're leaving a lot of money on the table. Thanks, guys. If you like this video, you're going to love my Clarity and Control course. It's absolutely free. You can find it in the description. It tells you how to get the clarity you've been looking for, whether you've been doing this for a year or 30 years, and how to get that control back over your money, your investing, or your trading. Again, I have an investing course. Part of my company, I have a trading course. There's a lot of similarities, but the nuance and differences is big. So understand which one you're really wanting to be, and it's going to help you so much. Thanks for being in my world, and I will see you on the next video. Thanks, guys. Bye.